Before we start, please remember that I am not a licensed insurance agent or financial advisor. This video is for educational purposes only and should not be taken as professional advice. Think of me as your guide, sharing my research to help you navigate this complex world. Always do your own research and consult with a qualified professional for your specific situation. What if I told you that for years, you've been playing a high-stakes game without knowing the rules, and the house always wins? This isn't Las Vegas. This is your auto insurance. Right now, the average American driver overpays by a staggering $417 a year. Let that sink in. For many, especially those in states like Michigan or Louisiana, that number easily tops $1,000. That's a mortgage payment. That's a family vacation. That's a significant investment in your future. And you're just handing it over year after year as a loyalty tax. And the most infuriating part? The insurance industry is built on this, thrives on it. They have spent billions of dollars on advertising with cute geckos and catchy jingles to create a sense of trust and familiarity, all while designing a system so intentionally complex, so saturated with confusing jargon and mind-numbing fine print, that most of us just throw our hands up in the air, sign whatever is put in front of us, and accept the price they dictate. Well, today we're flipping the table. Today, I'm handing you the official rulebook. I'm giving you the playbook the insurance companies use against you. We are going to pull back the curtain, expose the secrets, and turn you from a pawn in their game into the player who wins. The core of the problem isn't that you're a bad driver or that you're bad with money. The problem is that you've been conditioned to be a passive customer in a market that preys on passivity. You've been sold a lie that loyalty is rewarded. In the world of auto insurance, loyalty is often punished. There's a practice in the industry known as price optimization or elasticity modeling. It's a cold, calculated algorithm that determines how much they can raise your rate before you finally hit your breaking point and leave. It has nothing to do with your driving risk and everything to do with your shopping habits. The longer you stay, the more you prove you're inelastic, a loyal customer, and the more they can squeeze you. They're banking on the fact that you're busy. They know that comparing insurance is a hassle. They know you're afraid of having a lapse in coverage. They use this inertia to their advantage, bumping your premium up by 5% here, 7% there, so small you might not even notice until 5 years have passed and you're paying double what a new customer would pay for the exact same policy. This entire guide is designed to shatter that inertia. This is your wake-up call. We're not just going to find you a cheap policy. Cheap can be dangerous. We are going to find you the right policy at the best possible price. We will demystify every single term, from bodily injury liability to comprehensive other than collision, in plain, simple English. No more confusion, just the straightforward, actionable knowledge you need to take back control and keep your hard-earned money in your pocket. Let me tell you about Jessica. Jessica lives in a suburb of Dallas, Texas. She's 34, works in marketing, drives a 2019 Honda CR-V, and has a spotless driving record. No accidents, no speeding tickets, not even a parking violation in over a decade. She is the definition of a low-risk driver. Yet, she was paying a jaw-dropping $1,900 a year for her car insurance. That's over $150 every single month. And she just accepted it. Why? Because she did what millions of us do. 5 years ago, when she bought her car, she called up the big-name company her parents always used, got a quote and signed up. She put it on autopay and never thought about it again. The renewal notice would come in the mail. She'd glance at it, see a tiny increase of $10 or $15 and think, well, I guess that's just inflation. She was a loyal customer and in her mind that was a virtue. But to her insurance company, her loyalty was a bright, flashing dollar sign. It told them she wasn't looking elsewhere. It told them she was a set-it-and-forget-it customer, the most profitable kind. Her breaking point came when a coworker, who drove a more expensive car, mentioned he was paying only $1,200 a year. Jessica was floored. It was that single conversation that lit a fire under her. She realized she had been completely in the dark. That night she started digging, and by using the exact strategies we are about to cover in this guide, Jessica is now paying just over $1,100 a year. And get this, it's for better coverage than she had before. That's an $800 a year raise she gave herself, just by learning the rules of the game. Her story isn't an exception. It's a blueprint. So let's start by detonating the single biggest, most dangerous myth in the entire auto insurance landscape. It's a two-word phrase you've heard 1,000 times. Full coverage. You've heard friends say it, you've seen it online, you may have even asked an agent for it yourself. Here is the absolute truth. Full coverage does not exist. It is not a real insurance product. It is a marketing term, a piece of industry slang that has caused more financial devastation for unsuspecting drivers than almost anything else. It's a phantom. When people say full coverage, they generally mean a policy that bundles three key components. First, liability coverage, which pays for damage you cause to others and is required by law. Second, collision coverage, which pays to repair your own car after an accident. And third, comprehensive coverage, which pays for things like theft, fire, or hitting a deer. But here's the trap. The amount of that coverage is what matters. The term full coverage says nothing about your limits. You could have a policy with the bare minimum liability limits required by your state, which in some states is as low as $15,000, and a massive $2,000 deductible. If you cause a serious accident and injure someone, those medical bills could easily hit $100,000. Your full coverage policy would pay the first $15,000, and then you'd be on the hook for the remaining $85,000. They could sue you, garnish your wages, and put a lien on your house. Your life could be financially ruined, all while you thought you were fully covered. Believing in this myth is the first and most costly mistake. Prevents you from asking the critical questions. The most powerful shift you can make, starting this very second, is to banish the words full coverage from your vocabulary. Instead, you must learn to think in specifics. What are my bodily injury liability limits? What is my property damage limit? What is my collision deductible? Is it $500 or $1,500? Do I have uninsured motorist protection? These are the questions that unlock savings and, more importantly, provide real security. Understanding that one concept is your first major step toward becoming an empowered consumer. And we are just getting warmed up. Over the course of this guide, we are going to go so much deeper, transforming you from a novice into a master of your own financial protection. We are going to take that dense, intimidating document they send you in the mail, your policy declaration page, and we're going to translate it line by line into a simple, powerful tool you can use to your advantage. We will expose the top 5 hidden factors that are secretly driving up your insurance rates, things you have complete control over, but probably never even thought about. I will then give you the precise, step-by-step blueprint for comparison shopping like an absolute pro, showing you how to use online tools to create a bidding war where massive companies are forced to compete for your business, driving down their prices to win you over. We will then dive into the treasure trove of discounts, uncovering a list of over 15 common but often overlooked ways to save, from discounts for your occupation or the anti-theft devices in your car, to savings you can get just by paying your bill in full. By the end of this journey, the feeling of dread you get when you see that insurance bill will be replaced by a feeling of confidence and control. You will never again blindly accept a renewal offer. You will have the knowledge to negotiate from a position of strength, to ask the right questions, and to build a policy that perfectly fits your life without draining your bank account. The system is built to keep you in the dark, but the solution is stunningly simple: knowledge. So, let's get started on the first crucial piece of that knowledge: understanding the absolute bedrock of every single auto policy in America: liability coverage. It's the part of your policy that insurance companies and lawyers pray you don't understand. Because when you're in an accident, and it's your fault, liability coverage isn't for you. It's for the other guy. It pays for their broken bones, their wrecked car, their lost wages. It's the money that stops them from coming after your house, your savings, and your future earnings. Think of it as a financial shield. And right now, millions of Americans are walking around with a shield made of cardboard, thinking it's made of steel. This shield has two distinct parts: bodily injury liability and property damage liability. Let's start with the one that can bankrupt you the fastest: bodily injury. Imagine you're driving home on a rainy Friday. You're a little tired, the roads are slick. You glance down at your phone for just a second, a single fleeting second, and when you look up, brake lights flash red. You slam on your brakes, but it's too late. The crunch of metal is sickening. It's a 3-car pileup, and you're the one who started it. The driver in the car you hit, let's call her Susan, seems okay at first. Shaken up but walking. The person she hit, a man named David, is complaining of neck pain. Paramedics arrive, reports are filed, and you go home feeling shaken but relieved that no one was seriously hurt. But a week later, the letters start arriving. Susan's minor soreness turned into a herniated disc requiring surgery. David has severe whiplash and can't work his construction job for 3 months. Suddenly, you're not just looking at a few doctor's visits. You're looking at surgery costs, physical therapy and MRI, prescription drugs, and months of lost income for two different people. The total bill? It's climbing past $150,000. And it's still going up. This is where your bodily injury liability coverage kicks in. You'll see it on your policy as two numbers like 25/50th, or 50/100, or 100/300. These numbers represent thousands of dollars. The first number is the maximum amount your insurance will pay for any one person's injuries in an accident you cause. The second number is the maximum total amount your insurance will pay for all injuries combined in that single accident. Now let's go back to our pileup. Most states have a legal minimum for this coverage. In many places, it's a shocking $25,000 per person and $50,000 per accident. We call this 25/50th. This is what you have. You've just walked into a financial catastrophe. Your policy will pay the first $25,000 of Susan's medical bills. It will also pay the first $25,000 of David's medical bills and lost wages. That's a total of $50,000, which is your per accident limit. You've maxed it out, but the total bill was $150,000. So where does the other $100,000 come from? Comes from you. The attorneys for Susan and David will send you a letter demanding payment. If you don't pay, they will sue you. And they will win because you were at fault. A judge will issue a judgment against you for $100,000. To satisfy that judgment, they can legally seize your bank accounts. They can put a lien on your home. They can garnish your wages for years, taking a chunk of every single paycheck until the debt is paid. That 1 second you looked at your phone has now jeopardized your family's financial security for the next decade. Your dream of buying a bigger house? Gone. Your kids' college fund? Gone. Your retirement savings? Gone. This is the dirty secret of state minimums. They are designed to make you legally compliant, not financially safe. The state just wants to make sure there's something for accident victims. They don't care if you're ruined in the process. Choosing state minimum coverage is like betting your entire life savings that you'll never cause an accident with even a moderate injury. It is, without a doubt, the single worst gamble a person can make. Now let's talk about the second part of your liability shield: property damage. This is the third number you see in that sequence, like the 25 in 25/50/25. It's the maximum amount your policy will pay for any property you damage in an accident. And most people think, oh, that's for the other person's car. And you're right, but you're also dangerously wrong. It's for everything you damage. Let's change the scenario. You're on a quiet suburban street. You swerve to avoid a dog that runs into the road. You lose control and plow through a landscaped garden, smash a custom-built brick mailbox, and come to a stop after T-boning a brand new Ford F-150 parked on the street. Let's do the math. The average new car in America costs over $48,000. That F-150 you just hit? With today's complex sensors, cameras, and aluminum body panels, the repair bill could easily be $15,000. The custom brick mailbox? $3,000. The destroyed landscaping with mature shrubs and a sprinkler system? Another $4,000. You've just caused $22,000 in damage. If your state minimum for property damage is $25,000, you're safe. You breathe a sigh of relief. But what if it wasn't a Ford F-150? What if it was a Tesla Model S? Or a BMW? What if you didn't just hit one parked car, but two? What if you had slid off a highway ramp and taken out a critical piece of electronic equipment for the Department of Transportation? Or crashed into the front of a small business? Suddenly, a $25,000 limit looks terrifyingly small. A new Tesla can be totaled in a moderate accident, and you're instantly on the hook for $80,000 or more. If you only have $25,000 in coverage, you are personally responsible for the remaining $55,000. Again, they will sue you, they will win, and they will come for your assets. The crazy part, the part that should make you angry, is how cheap it is to upgrade this protection. The difference between a flimsy, state minimum cardboard shield and a fortress of financial protection is often trivial. Going from a disastrous 25/50/25 policy to a much safer 100/300/100 policy might cost you $10, maybe $15 a month. The price of 2 lattes. Think about that. For the cost of a couple of coffees, you can increase your bodily injury protection from $25,000 to $100,000 per person. You can increase your total accident protection from $50,000 to $300,000. You can increase your property damage protection from a paltry $25,000 to a solid $100,000. You are trading a few dollars for hundreds of thousands of dollars in peace of mind. There is no better return on investment in the entire world of personal finance. So what's the right amount? While it depends on your personal assets, a good starting point for most people in today's world is 100/300/100. If you own a home or have significant savings, you should be looking at even higher limits like 250/500/100. This isn't about being reckless. It's about being realistic. It's about understanding that a single moment of distraction can have lifelong consequences, and that for a tiny fraction of your income, you can ensure that one mistake doesn't unravel everything you've ever worked for. Liability coverage isn't the exciting part of insurance. It doesn't fix your car or pay your own medical bills. It does something far more important. It stands guard over your entire life. It's the silent protector that allows you to sleep at night, knowing that if the worst happens, you won't lose everything. So now you understand how to protect yourself from ruining someone else's life and your own in the process. You've built the financial fortress to shield you from lawsuits. But what about you? What about your own car? What happens when you're the one who gets hit by an uninsured driver, or a tree falls on your car, or your brand new SUV gets stolen from your driveway? That's when you realize your liability shield, as strong as it is, does absolutely nothing to protect your own property. To do that, you need two other types of coverage, a powerful duo that might be the most misunderstood part of any auto policy in America. And that powerful duo is known as collision and comprehensive coverage. Think of it this way. If liability is a shield that protects you from others, collision and comprehensive are the suit of armor that protects your own vehicle. And the way they work is the source of massive confusion, costing drivers millions of dollars a year in bad decisions. So let's clear it up right now with a simple story. Imagine you're driving home from work. You're doing everything right. You're stopped at a red light, humming along to the radio. Suddenly, bam, a gut-wrenching jolt from behind. You've been rear-ended. You and the other driver pull over. Thankfully, no one's hurt, but the back of your car looks like a crumpled tin can. The other driver is apologetic, they admit fault, and they have insurance. You breathe a sigh of relief. You think, okay, their liability insurance will cover my repairs. No problem. But what if it's not that simple? What if their insurance has a low property damage limit, say only $10,000, but your car is a newer model and the repair estimate comes back at $15,000? Their insurance pays its max, and you're left on the hook for the extra $5,000. Or worse, what if the driver who hit you is one of the nearly 13% of American drivers who has no insurance at all? Now you're staring at a $15,000 bill for an accident that wasn't even your fault. This is where the first piece of your car's armor, collision coverage, steps in and saves your financial life. Collision coverage pays to repair or replace your car if it's damaged in a collision with another vehicle or object, like a guardrail, a telephone pole, or a particularly sturdy mailbox. And here is the most important part. It covers you regardless of who is at fault. If the other driver is uninsured, you're covered. If they're underinsured, you're covered. And let's be honest, it happens, the accident was your fault, you are still covered. Your collision coverage becomes your safety net. But there's a catch. It's a word you've heard 1,000 times but might not fully grasp. The deductible. Your deductible is the amount of money you have to pay out of pocket for a repair before your insurance company starts paying. Think of it as your share of the cost. These typically range from $250 to $1,000 or even more. Let's go back to our accident. The repair bill is $15,000, and you have a policy with a $500 collision deductible. You pay the first $500 directly to the body shop. Your insurance company then pays the remaining $14,500. Choosing your deductible is one of the most critical decisions you'll make. A lower deductible like $250 feels safe. If something happens, you're not out much cash. But that safety comes at a price, a significantly higher monthly or semi-annual premium. On the other hand, a higher deductible, say $1,000, means you're taking on more of the initial risk yourself. But your reward for taking on that risk is a much lower insurance premium. The secret is finding the sweet spot. A deductible high enough to lower your premium to a comfortable level, but low enough that you could actually afford to pay it tomorrow if you had to, without causing a financial crisis. So that's collision. It's your protection from the crunch of an impact. But what about all the other bad things that can happen to a car that don't involve a collision? Let's rewind. The accident never happened. Instead, you wake up one morning, walk outside with your coffee, and your heart sinks. A massive ice storm overnight caused a huge tree limb to snap and crush the roof of your car. Or maybe you come out of the grocery store to find your car is just gone, stolen. Or maybe you live in a rural area and a deer decides to use your front grille as a launching pad. In all of these scenarios, your collision coverage would be useless. You didn't collide with another car or a stationary object. This is where the second piece of the armor, comprehensive coverage, comes into play. Comprehensive is sometimes called other than collision coverage, and that's the perfect way to think about it. It covers damage to your car from just about everything else: theft, vandalism, fire, flooding, hail, falling objects, and hitting an animal. It's the acts of God and chaos policy. Just like collision, it also has a deductible. And a pro tip: your comprehensive deductible doesn't have to be the same as your collision deductible. Since comprehensive claims are often less frequent and sometimes less severe, many people opt for a lower deductible on their comprehensive coverage, giving them better protection against things like a cracked windshield for a very small increase in their premium. Now, when you put these two coverages together, collision and comprehensive, on top of your required liability coverage, you get what people commonly refer to as full coverage. And this is a crucial point. Full coverage is not an official insurance term. You can't call an agent and say, "Give me full coverage." It's a slang phrase that simply means a policy includes all three pillars: liability, collision, and comprehensive. Understanding this distinction is vital because it means you have control over the components. You are the one who builds your full coverage policy by selecting the limits and deductibles for each part. So the big question remains, do you actually need this suit of armor for your car? Unlike liability, no state in the country legally requires you to carry collision or comprehensive coverage. The decision comes down to one of two factors. First, and most importantly, do you have a loan or a lease on your car? If the answer is yes, then the decision has already been made for you. The bank or finance company that technically owns your vehicle until it's paid off will absolutely require you to carry both collision and comprehensive coverage, with a maximum deductible amount, usually $500 or $1,000. Why? Because the car is their asset. It's the collateral for your loan. They need to ensure that if the car is totaled or stolen, their investment is protected. If you let this coverage lapse, they have the right to buy a policy for you, a very expensive one, and tack the cost onto your loan payment. But what if you own your car outright? No loan, no lease. The title is in your name, free and clear. Now the choice is entirely yours. And the decision should be a simple, cold, hard calculation. You need to weigh the cost of the coverage against the value of your car. The key term here is actual cash value, or ACV. This isn't what you paid for the car. It's what the car is worth today, factoring in depreciation, mileage, and condition. It's what your insurance company would pay you if your car were totaled. You can get a good estimate of your car's ACV from sites like Kelley Blue Book or Edmunds. Here's the formula. Take your car's ACV, subtract your deductible, and then compare that number to the annual cost of carrying collision and comprehensive coverage. For example, let's say you have a 12-year-old sedan worth $3,000. You have a $500 deductible. The most your insurance would ever pay out is $2,500. If the annual cost for collision and comprehensive is $700, you're paying a significant chunk of the car's value every year just to protect it. In this case, it might be smarter to drop the coverage, bank the $700 you're saving, and essentially self-insure. If something happens, you use that saved money for repairs or a down payment on a new car. But if your car is worth $20,000, paying $700 a year to protect against a potential $20,000 loss is an absolute no-brainer. You keep the coverage. Understanding this balance between your car's value and the cost of protecting it is the secret to not overpaying for insurance. You've now built the core of a great policy: a liability shield to protect your assets and a suit of armor for your car. But we're not done. Because hiding in the fine print of every policy are a handful of smaller, optional coverages. Most people skip right over them, but ignoring them can be a catastrophic mistake, leaving you stranded, out of pocket, and in a far worse financial position than you ever imagined. And it's these powerful, often misunderstood options we're breaking down next. Let's start with the one most people recognize, but few truly understand the value of: roadside assistance. Imagine this. It's 11 o'clock at night. You're on a poorly lit stretch of highway, miles from the next exit. Rain is starting to fall, and your car just sputters and dies. The battery is dead, or maybe it's a flat tire. Your phone has 15% battery left. That feeling of dread of being completely stranded and vulnerable. It's awful. You start frantically searching for a local towing company. You find one, They quote you $250 cash just to come out and tow you to the nearest garage, which is closed until morning. And that's a cheap quote. A tow can easily run you $400, $500, even $600 depending on how far you are from civilization. Now imagine the same scenario, but you have roadside assistance on your auto policy. Instead of a frantic, expensive search, you open your insurance app, press a button, and you're done. You know that help is on the way. You know a tow truck will arrive to take you to a safe location. You know if it's just a dead battery, they'll give you a jump. If it's a flat, they'll help you put on the spare. If you locked your keys in the car, they'll get you back in. All of this for a cost that usually amounts to less than a fancy cup of coffee per month. We're talking maybe $2 to $4 a month on your premium. You pay that one-time $250 towing bill, and you've just paid for about a decade's worth of roadside assistance coverage. It transforms a potential financial emergency and a terrifying ordeal into a manageable inconvenience. But here's the critical piece of advice most people miss. Check if you're already covered. Before you add this to your policy, look at your premium credit card benefits. Look at your new car's manufacturer warranty. Are you a member of an auto club like AAA? Many people are paying for this service twice or even 3 times without realizing it. So do a quick audit first. If you're not covered, adding it to your auto policy is one of the highest value, lowest cost decisions you can make. Next up is the one that saves you from a logistical nightmare: rental reimbursement. Let's say you get into an accident. It wasn't your fault, but your car is out of commission. The body shop tells you they can fix it, but with the way supply chains are right now, it's going to take 3 weeks to get the parts. 3 weeks. 21 days. How do you get to work? How do you take your kids to school? How do you get groceries? Suddenly, your life is thrown into chaos. You're looking at Ubering everywhere, which will cost a fortune, or renting a car out of pocket. A basic rental car can cost $50, $60, even $80 a day. Over 3 weeks, you could easily be looking at a bill for over $1,500. That's $1,500 you have to pay after you just dealt with the stress of a car accident. Rental reimbursement coverage is your shield against this. For just a few extra dollars a month, your insurance company will cover the cost of a rental car while yours is being repaired after a covered claim. Policies are usually written with a daily and a total limit, something like 30/900. This means they'll pay up to $30 per day, for a maximum of $900 total. You can often pay a little more for higher limits like $50 a day. When you're getting a quote, look at this option and ask yourself one simple question. If my car was gone for a month, could my life function without it? If the answer is no, this coverage isn't a luxury. It's an absolute necessity. It prevents a bad situation from spiraling into a financial and logistical crisis. Now let's talk about the big one, the one that can literally save you from financial ruin, especially if you have a newer car. It's called gap insurance. And to understand why it's so important, you first need to understand a brutal financial truth. The moment you drive a new car off the dealership lot, its value plummets. This is called depreciation. Your car is now a used car, and it's worth thousands of dollars less than what you paid for it just minutes before. Here's the nightmare scenario where gap insurance becomes your hero. Let's say you buy a brand new car for $35,000. You make a small down payment and finance the rest. 6 months later, you're in a terrible accident, and the car is declared a total loss. It's completely wrecked. You're okay, thankfully, but the car is gone. Now, you might think your insurance company will cut you a check for $35,000 to pay off your loan. That is absolutely not what happens. Your collision coverage pays you the actual cash value of the car at the time of the accident. Because of that instant depreciation, the actual cash value of your 6-month-old car might only be $28,000. But you still owe $32,000 on your loan. Do you see the problem? The insurance company gives you a check for $28,000. You still have to pay the bank $32,000. You are now $4,000 in debt, you have no car, and you still need to figure out how to buy a new one. This is what it means to be upside down on your loan. And it is a devastating financial trap. Gap insurance is designed specifically to cover this gap. It pays the difference between the actual cash value your insurer gives you and the amount you still owe on your loan or lease. In our scenario, it would pay that $4,000 difference, leaving you with a zero balance. You can walk away clean without a mountain of debt for a car that no longer exists. So who needs this? You almost certainly need gap insurance if you made a down payment of less than 20%, if you finance for 60 months or longer, or if you bought a vehicle that depreciates faster than average. And here is a world-class tip. Do not buy gap insurance from the car dealership. The finance manager will try to sell it to you, often rolling it into your loan for a massively inflated price, sometimes over $1,000. Call your auto insurance company first. You can almost always add it to your policy for a tiny fraction of that cost, saving you hundreds and hundreds of dollars. Finally, let's look at a few powerful, more specialized options. If you have a brand new car, you might see something called new car replacement coverage. This is like gap insurance on steroids. If your new car is totaled, usually within the first year or two of ownership, this coverage doesn't just pay off the loan. It gives you the money to buy a brand new car of the same make and model, not just the depreciated value. It's more expensive, but it provides ultimate peace of mind for new car owners. Do you have custom parts on your car? A high-end sound system, expensive custom wheels, a special paint job? Your standard policy will not cover those things. If your car is stolen or wrecked, they'll only pay to replace the factory standard parts. To protect your investment, you need custom parts and equipment coverage, or CPE. It specifically covers the value of your aftermarket additions. And one last one, which is becoming increasingly important with modern, complex vehicles: an OEM endorsement. OEM stands for Original Equipment Manufacturer. When your car is repaired, shops will often use cheaper, aftermarket parts to save money. An OEM endorsement ensures that only factory parts, the exact same ones your car was built with, are used in repairs. For a lease or a newer car with advanced safety systems, this can be critical for ensuring the vehicle functions exactly as it was designed to. These aren't just random add-ons designed to take your money. They are specific tools for specific risks. The key isn't to buy all of them. The key is to look at your personal situation, your car, your loan, your savings, your daily needs, and strategically build a policy that protects you from the disasters that would hurt you the most. By understanding these options, you're no longer just a price shopper. You're becoming a savvy risk manager. Now that we understand how to build the perfect fortress of coverage, tailored specifically to your life, it's time to talk about the most exciting part: getting that fortress for the lowest possible price. It's time to go on the offensive and hunt down every single discount you're entitled to. And some of them are so obscure you'd never even think to ask for them. Let's start with the ones you've probably heard of, the low-hanging fruit. But even here, there's a secret layer most people miss. First up, the good driver discount. This sounds simple, right? Don't crash your car. But what does that actually mean to an insurer? For most, it means you've been licensed for at least 3 years and have had no at-fault accidents, no DUIs, and no major moving violations in the last 3 to 5 years. Here's the pro tip. Don't just assume you qualify. Before you even start shopping, pull a copy of your motor vehicle report from your local DMV. Check it for errors. A clerical mistake from 2 years ago could be costing you hundreds of dollars right now. You need to be your own advocate and make sure your record is clean before you present it to an insurer. If it is, you don't just ask, "Do you have a good driver discount?" You say, "My record has been spotless for 5 years. I expect your best possible preferred driver rate." It's a completely different conversation. Next, the good student discount. If you or a driver on your policy is in high school or a full-time college student under the age of 25, this is a potential goldmine. The typical requirement is maintaining AB average or a 3.0 GPA. But here's where people leave money on the table. They think it's just for teenagers living at home. Wrong. It applies to your kid away at college too. And that brings up its sister discount, the student away at school discount. If your child is attending college over 100 miles away from home and didn't take a car with them, you can get a massive discount. The logic is simple. They aren't driving your insured car every day, so the risk is way lower. But the insurance company isn't going to magically know your kid's zip code and GPA. You have to hand them that report card and that college address and demand the savings. Okay, that's the easy stuff. Now let's talk about your car itself. Your vehicle is a walking, talking bundle of potential discounts. Insurers love safety features, and the more you have, the more they'll reward you. We're not just talking about airbags. Get a pen or open a note on your phone and check your car for these: anti-lock brakes or ABS, daytime running lights, electronic stability control or ESC. If your car was made in the last decade, you probably have all three. But did you tell your insurer? Next, anti-theft systems. This is a big one. There are 2 types: passive and active. A passive system, like an engine immobilizer that's built into your key, automatically arms itself. You don't have to do anything. An active system is one you have to turn on, like a traditional car alarm. Both can get you a discount, but you need to know which one you have. Even something as simple as VIN etching, having your vehicle identification number professionally etched onto your windows, can sometimes shave a few percentage points off your premium. It makes your car harder for thieves to sell, which makes insurers happy. Add them all up. ABS ESC, daytime lights, anti-theft, VIN etching. That's 5 separate discounts you might be missing, just from the car sitting in your driveway. Let's move on to how you pay, because you can get paid just for being easy to work with. Every insurance company has to spend money on billing, sending letters, processing checks. It's a hassle for them, so they will pay you to make their life easier. Ask for the paid in full discount. If you can afford to pay your entire 6-month or 1-year premium upfront, you can often get a 5 to 10% discount right off the top. Why? Because the company gets all its money immediately and doesn't have to worry about you missing a monthly payment and lapsing your coverage. No credit card? No problem. Ask for the electronic funds transfer, or EFT discount. By letting them automatically pull the payment from your bank account each month, you're saving them administrative costs, and again, they'll pass some of those savings to you. While you're at it, go paperless. Opting for email statements instead of snail mail can knock another couple of bucks off your bill. Paid in full, autopay, paperless. These are 3 discounts that have nothing to do with your driving and everything to do with simple logistics. It's free money. Now for the really juicy stuff. The discounts tied to who you are and what you do. This is where we find the truly obscure savings that most people never ever think to ask about. Let's start with your job. What you do for a living can make you a lower risk in the eyes of an insurer. Actuaries have found that people in certain professions get into fewer accidents. Who are these people? Engineers, scientists, teachers, professors, firefighters, police officers, and nurses often qualify for an occupation discount. They're seen as more meticulous, more risk-averse. Are you an active-duty military member or a veteran? There are huge discounts available for you, not just from companies that cater specifically to the military, but from most major carriers. You have to ask. It doesn't stop with your job. It extends to groups you belong to. Are you a member of an alumni association from your university? A professional organization like the American Medical Association or the National Education Association? Even a wholesale club or a group like AARP? All of these organizations often have partnership deals with insurance companies to offer their members special group rates. Think about every group you pay dues to. Go to their website and look for member benefits or discounts. You might be sitting on a pre-negotiated deal that could save you hundreds. This is one of the biggest secrets in the industry. Sometimes the cheapest insurance you can get is through a group you already belong to for a completely different reason. And here's a big one. Do you own a home? Even if you're not insuring your home with the same company, just being a homeowner makes you a more attractive customer. Insurers see homeowners as more financially stable and responsible. They stay in one place longer, they're less likely to miss payments, and statistically, they're safer drivers. This homeowner discount can be substantial, and it's a separate thing from the bundling discount we'll talk about in a second. Let's talk about a discount that became incredibly important in the last few years: the low mileage discount. With so many people working from home, millions of Americans are driving significantly less than they used to. Insurance is based on risk, and the less you're on the road, the lower the risk. If you drive less than about 7,500 miles per year, which is about 145 miles a week, you could qualify for a serious discount. But you have to prove it. Take a picture of your odometer when you start your policy, and be prepared to show it again at renewal. Your daily commute going from 20 miles to 20 feet is a material change in risk, and you deserve to be compensated for it. Okay, let's stack these things together for maximum firepower. The single biggest discount available for most carriers is the multi-policy discount, also known as bundling. It's the combo meal of the insurance world. When you insure your car and your home or your apartment with the same company, you're not just a car insurance customer anymore. You're a household. You're a much more valuable, stickier client, and they will fight to keep you. Bundling your auto with your homeowner's or renter's insurance can slash 10, 15, even 25% off both policies. It's the one-two punch that can deliver a knockout blow to high premiums. Add in a multi-car discount if you have more than one vehicle, and the numbers start to get really exciting. Finally, there are 2 proactive discounts you can earn. The first is for taking a defensive driving course. If you have a recent speeding ticket or a minor accident on your record, this is your get-out-of-jail-free card. Spending a Saturday and $50 on a state-approved defensive driving course can not only remove points from your license, but it can also trigger a discount on your insurance that lasts for 3 years. The savings on your premium will almost always be more than the cost of the course. The second and most modern discount is telematics or usage-based insurance. This is the one where the insurance company monitors your driving through a small device you plug into your car or an app on your smartphone. Now, I know what you're thinking, privacy, and that's a valid concern, but let's look at the deal they're offering. The app tracks things like how hard you brake, how fast you accelerate, what time of day you drive, and how many miles you cover. If you're a genuinely safe driver who doesn't speed, doesn't slam on the brakes, and doesn't drive a lot late at night, this can translate into a massive discount. We're talking up to 40% off in some cases. It's a way of proving you're better than the average driver in your demographic. Many programs now have a no-penalty guarantee, meaning your rates won't go up based on the data, they can only go down. It's a calculated trade-off, your driving data in exchange for a premium that's based on your actual, real-world habits, not just statistics. Okay, take a breath. That was a lot. We've just built a checklist of over 20 potential discounts. From your GPA to your job, from your anti-lock brakes to your alumni association. You are now armed with an arsenal of money-saving questions. But knowing what to ask for is only half the battle. Now you have to know who to ask and how to make them compete for your business. Now that you have your arsenal of discounts, where do you go to use them? Do you call a local agent? Do you go to a big company's website? Or is there a third secret option that pits these companies against each other in a bidding war for your business? In the next part, we're going to break down the 3 battlefields of insurance shopping, and I'll show you exactly which one will get you the absolute lowest price. These 3 battlefields are the captive agent, the independent agent, and the direct-to-consumer route. Understanding the strengths and weaknesses of each is the absolute key to not getting ripped off. Think of it like this: you need a new sword. You could go to the one blacksmith your family has always used. You could go to the central market where all the blacksmiths sell their wares. Or you could travel to each blacksmith's forge yourself and negotiate directly. Each path can get you a sword, but only one will get you the best sword for the best price. Let's start with the first battlefield, the captive agent. The name says it all. This agent is captive to one single insurance company. Think of the big names you see on every street corner. State Farm, Allstate, Farmers, American Family. When you walk into one of their offices, you are walking into an embassy for that one company. The agent is a specialist, a master of their kingdom's products. They know every single discount, every policy rider, every bundling opportunity that their company offers. They can be fantastic if you value a long-term, personal relationship. They're the person you call when you have a claim, when you buy a new car, when your kid gets their license. They can offer a seamless experience, especially if you plan on bundling your auto insurance with your home or renter's insurance from that same company. But here's the massive, unmissable drawback. That captive agent can only sell you one brand of sword. They might have the best State Farm policy in the world for you, but they will never ever be able to tell you if Progressive or Nationwide could beat that price by $300. It's not because they're bad people, it's because their hands are tied. Their entire job, their commission, their loyalty is to that one company. So, when they tell you you're getting the best deal, what they mean is you're getting the best deal that they can possibly offer you. It's a huge distinction. Going to a captive agent is a bet. You're betting that out of all the dozens of insurance companies in America, the one single company they represent just happens to be the cheapest one for you. It's a gamble, and most of the time, it's a losing one if your only goal is finding the rock bottom price. Now let's move to the second battlefield, which is a total game changer: the independent agent. If the captive agent is a loyal soldier to one kingdom, the independent agent is a highly skilled mercenary who works for you. They don't work for State Farm. They don't work for Progressive. They work for you, the customer. An independent agent or broker has contracts with multiple different insurance companies, sometimes a dozen or more. Their job is to take your information one time, understand your needs, and then shop you around to all the different carriers they represent to see who comes back with the best combination of coverage and price. This is where the power dynamic completely flips. Instead of you going to the companies are now forced to compete for your business through the agent. This is the bidding war we talked about. The agent can lay out 5 different quotes for you side by side from companies like Travelers, The Hartford, Safeco, and others you might not have even heard of. They can give you unbiased advice on which company has better claims service, or which one offers a specific discount you qualify for. They do all the legwork. You fill out one application, have one conversation, and you get access to a huge portion of the market. And if your rate goes up next year, you don't have to start the whole process over. You just call your independent agent and say, "Hey, can you shop me around again?" It's an incredibly efficient system. So what's the catch? There are two small ones. First, independent agents don't represent every company. Some of the biggest direct-to-consumer players like Geico don't use agents at all. So an independent agent can't get you a Geico quote. Second, they are paid by commission from the insurance company they place you with. However, the commissions are usually very similar across companies. So a good, ethical agent is motivated to find you the best policy to keep you as a happy, long-term client, not to push you toward a slightly higher commission. For most people who want expert guidance and a wide net cast for them, the independent agent is a powerful, powerful ally on the battlefield. This brings us to our third and final battlefield, the direct-to-consumer assault. This is you, the lone wolf. This is you in your pajamas at midnight, armed with a laptop and a credit card going straight to the source. Companies like Geico and Progressive built their entire empires on this model. They cut out the agent, the middleman, and passed some of those savings on to the consumer. Their message is simple. Why talk to an agent when you can go online, get a quote in 15 minutes, and save a ton of money? And for many people, they're right. The upside here is total control and convenience. You're not bound by office hours. You can tweak your coverage levels up and down and see the price change in real time. You can compare quotes from Geico, Progressive, and any other direct writer whenever you want. You are the general of your own army. But this path is also filled with traps for the unprepared. The biggest downside is the sheer amount of work involved. If you want to compare 5 different direct insurers, you have to go to 5 different websites and fill out your information, your name, address, VIN number, driving history 5 separate times. It can be tedious and time-consuming. And the bigger danger is this: you are your own expert. When Geico offers you bodily injury liability of 50/100 and Progressive offers 100/300, do you know what that means? Do you know which one you actually need? When one quote has a $500 collision deductible and another has a $1,000 comprehensive deductible, are you truly comparing apples to apples? It's incredibly easy to just pick the cheapest price you see, without realizing you've chosen a policy with dangerously low coverage that could leave you financially ruined after a serious accident. Going direct puts all the responsibility for making an informed decision squarely on your shoulders. So we have the 3 battlefields: the captive agent, loyal, knowledgeable but limited; the independent agent, your personal mercenary, casting a wide net for you; and the direct route, you are in total control but also totally on your own. Which one gets you the lowest price? The honest, no-fluff answer is, it depends. But for the vast majority of people looking for the absolute lowest premium, the clear winner is a 2-pronged attack. You must engage on at least 2 of these battlefields. The most powerful combination is to use an independent agent to cover a huge swath of the market with one shot, and then personally go direct to the few big companies that the agent can't quote, like Geico. By doing this, you're covering nearly every base. You get the expert advice and wide reach of a broker, and you personally check the big direct players to make sure no stone is left unturned. This strategy forces maximum competition and almost guarantees you will find the lowest possible rate for the coverage you need. It takes a little more effort than just making one phone call, but that extra hour of work can easily save you $500 to $1,000 a year. But hold on. Before you pick up the phone to call an agent or even type Geico into your browser, stop. Charging onto the battlefield without the right equipment is a recipe for disaster. You will waste your time, you will get inaccurate quotes, and you will end up overpaying. There is a pre-flight checklist of information and decisions you must have finalized before you ever ask for a single quote. Getting these things right up front is the secret to a fast, accurate, and money-saving process. And in the next part, I'm going to give you that exact checklist. I'll show you the 5 things you absolutely must have on the desk in front of you before you start shopping for auto insurance. Don't even think about getting a quote until you see this. Alright, let's get this done. This isn't just a list. This is your arsenal. Think of this as preparing for a negotiation. You wouldn't walk into a car dealership without knowing the car's price. And you shouldn't shop for insurance without these 5 things. This is the difference between saving a few bucks and saving a few $100. First, and this is the absolute non-negotiable cornerstone of your entire mission, you need your current insurance policy's declarations page. The deck page, as it's called in the industry. This is your current battle plan. It's a 1 or 2-page summary that shows exactly what you're paying for right now. Why is this so critical? Because without it, you're shopping blind. You're comparing apples to oranges. I once had a friend, let's call him Mark, who was so proud he saved $150 a year by switching companies. He was bragging about it for weeks. Then, he got into a minor fender bender. His fault. The other driver needed some physical therapy. Suddenly, Mark found out his new cheaper policy had state minimum liability limits. His old policy had much higher protection. The medical bills exceeded his new, tiny limit, and the other driver's insurance company came after him personally for the $30,000 difference. His $150 savings cost him $30 grand. Don't be Mark. Pull out your deck page. You can find it online in your account portal or they mail it to you. Look at the numbers. You'll see something like bodily injury liability, with numbers next to it, maybe 100/300. That means your policy will pay up to $100,000 for one person's injuries in an accident you cause, and up to $300,000 total for all injuries in that single accident. You'll see property damage liability, maybe with a 50 next to it. That's $50,000 to repair or replace the other person's car or property. You need to know these numbers. This is your baseline. When you get a new quote, you need to ask for the exact same liability limits. That's the only way to do a true apples-to-apples price comparison. Your deck page also shows your deductibles for collision and comprehensive. That's the amount you have to pay out of pocket before the insurance company pays for repairs to your car. Is it $500? $1,000? Again, write it down. You need to compare quotes with the same deductibles. This single piece of paper is your map. It tells you where you are right now, so you can intelligently navigate to a better deal without sacrificing the protection your family actually needs. Number 2 on your checklist. The vehicle identification number for every car you want to insure. The VIN. This is your car's unique fingerprint. It's its DNA. So many people just say, "Oh, I have a 2021 Toyota Camry." But that's not enough information. Was it the LE model? The XSE? Does it have the V6 engine? Does it have the optional safety package with blind spot monitoring and automatic emergency braking? The VIN tells the insurance company everything. It's a 17-digit code that decodes the exact make, model, trim level, engine size, and most importantly, the specific safety features that were installed at the factory. Here's why it matters. Insurance companies give massive discounts for safety features. Anti-lock brakes, airbags, electronic stability control, lane departure warnings. These all lower your risk, so they lower your price. If you just tell them you have a Camry, they might quote you on the base model with 0 options, and you'll miss out on all the discounts for the safety features you actually have. Providing the VIN eliminates all guesswork. It ensures you get every last bit of credit for having a safer car. You can find the VIN in a few places. Look at the corner of your dashboard through the driver's side of the windshield, check the sticker on the inside of the driver's side door jamb, or just look at your current insurance card or vehicle registration. It's right there. Have it ready. Copy and paste it into online forms. Read it clearly over the phone. It is your key to unlocking hidden safety discounts. Third, you need the driver's license number and date of birth for every licensed driver in your household. This is your team roster. An insurance policy doesn't just cover a car. It covers the people who drive it. That includes you, your spouse, and any licensed kids living at home. The insurance company needs this information to pull a driving record, or MVR, for each person. This is where people get nervous. They think, "Oh no, my husband got a speeding ticket 2 years ago. Maybe I shouldn't list him." That is the single worst thing you can do. It's a form of misrepresentation that can lead to your claim being denied and your policy being canceled. You have to be honest. But here's the strategic part. Every insurance company weighs risk differently. One company might see that 2-year-old speeding ticket and jack up your rates by 20%. Another company, however, might have a policy where a single minor ticket over 18 months old has almost no impact on the price. You don't know which is which until you shop around. By having all the driver information ready up front, you're giving each company the full, accurate picture. This allows you to find the company that is the most forgiving for your specific family's driving history. It's not about hiding the bad. It's about finding the company that cares about it the least. So gather those license numbers. It's about transparency, and that transparency is what will lead you to the right fit at the right price. Fourth on your desk should be a realistic estimate of your annual mileage. This is your usage report. How much do you actually drive? Don't just guess. Most people wildly overestimate their mileage, and it costs them money. They say, "Oh, about 12,000 miles a year." because it sounds like a standard number. But what if you work from home 3 days a week? What if your commute is only 10 minutes? You might only be driving 7 or 8,000 miles a year. To an insurance company, fewer miles means less time on the road, which means less risk of an accident. And less risk means a lower premium. Here's a simple trick to get a super accurate number. Find the receipt from your last oil change. It has the date and the exact mileage of your car on that day. Now go look at your car's odometer. Subtract the old mileage from the current mileage. Let's say you drove 2,000 miles in the 4 months since your last oil change. Since there are 3 4-month periods in a year, you just multiply that 2,000 by 3. Your annual mileage is 6,000 miles, not the 12,000 you might have guessed. That simple calculation could unlock a significant low mileage discount. Take 5 minutes to do the math. It's one of the easiest ways to prove to the insurance company that you are a lower risk driver. Finally, number 5. This one isn't a document you find. It's a list you create. This is your secret weapon. A personalized checklist of every potential discount you might qualify for. You need to make this list before you start shopping. Why? Because you can't rely on the agent or the website to ask you all the right questions. You have to be your own advocate. So open a notepad and start brainstorming. Are you a member of any organizations? AARP, AAA, a university alumni association, a credit union, even wholesale clubs like Costco can offer group discounts. Do you have a student in the house with a B average or better? That's a good student discount. Have you taken a defensive driving course in the last 3 years? Get that certificate. Do you own a home? That's a huge bundling discount. Even if you insure your home with a different company, just being a homeowner makes you a more stable risk. Think about your job. Many companies offer discounts for certain professions like teachers, nurses, engineers, scientists, and first responders. Do you have winter tires? An anti-theft system? Have you been with your current company for over 3 years? That's a loyalty discount you can leverage with new companies. Make a physical list. Having it in front of you during the quoting process is your safety net. As you talk to an agent or fill out a form, you can literally check them off. Did you apply the good student discount? Did you apply the professional organization discount? You become an active participant, not a passive consumer. You are hunting for every single dollar of savings you are entitled to. So there you have it. Your declarations page, your VIN, your household's driver's license numbers, your accurate annual mileage, and your personal discount checklist. This is your 5-point plan for success. This is the prep work that separates the savvy shoppers from the people who overpay year after year. With this arsenal of information on your desk, you are now officially ready to engage. You're prepared to get fast, accurate quotes and to compare them like a pro. But this brings up the most important question of all. Where do you go? Who do you talk to? Do you call a local agent? Use a massive online comparison site? Go directly to the big-name companies themselves? Each path has hidden traps and unique advantages. Choosing the wrong one can mean leaving hundreds of dollars on the table. In the next part, we're going to break down these 3 channels, and I'll reveal the one method that consistently uncovers the best deals that aren't always advertised to the public. Let's dive right into those 3 channels. When you set out to buy car insurance, you're essentially walking down one of 3 distinct paths, and the path you choose has a massive impact on the price you pay and the protection you get. Think of it like buying a new smartphone. You can go to the Apple Store, you can go to a big box retailer like Best Buy that sells all the brands, or you can just order it directly from a carrier's website. Each has its pros and cons. It's the exact same with insurance. The first path is the captive agent. This is probably what many of us picture when we think of an insurance agent. These are the folks who work for a single specific company. Think of your local State Farm agent, your Allstate agent, or your Farmer's agent. Their name is right there on the sign. They are experts, but they are experts in one brand. The biggest advantage of working with a captive agent is the personalized service and deep product knowledge they have about their company. They know every single discount, every policy rider, and every nuance of the coverage their company offers. If you value having a single point of contact, someone you can call directly who knows your name and your history, a captive agent can be fantastic. They can help you bundle your home, auto, and life insurance, often unlocking significant multi-policy discounts that are specific to that one carrier. If that particular company happens to be a perfect fit for your specific needs and driving record, you might just get a great deal. But here's the catch, and it's a big one. A captive agent works for the insurance company, not for you. Their loyalty is to their employer. They can only sell you products from their one company. It's like walking into a Ford dealership and asking the salesperson to show you the best deal on a new truck. They're going to show you a great Ford F-150. They'll tell you all about its features, its towing capacity, its reliability. But they are never ever going to tell you that the Chevy or Ram dealership down the street has a comparable truck on sale for $5,000 less. It's not their job. A captive agent cannot shop the market for you. If their company's rates go up next year, and they often do, their only solution is to try and rework your policy within their system. They can't just pivot and say, well, let's see what Progressive can offer you instead. To do that, you have to start the entire shopping process all over again by yourself. The second path is the one that's become incredibly popular in the internet age, going direct to consumer. This is your Geico, your Progressive, your Esurance. You see the commercials, you go to the website, you fill out a form, and you get a quote in minutes. The appeal here is obvious. It's fast, it's convenient, and you feel like you're in control. You can do it at midnight in your pajamas. There's no salesperson, no pressure. For someone who is confident, knows exactly what coverage limits they need, and understands the terminology, this can be an efficient way to get a policy. You can get a quote from Geico, then hop over to Progressive's site and get another one, comparing them side by side. But this convenience comes with a huge hidden risk. When you go direct, you are acting as your own insurance agent. The website isn't there to give you advice. It's there to sell you a policy based on the information you provide. It's incredibly easy to make a costly mistake. Do you know the difference between uninsured and underinsured motorist coverage? Do you know if you need rental reimbursement or if it's covered by your credit card? Do you know what bodily injury liability limits are truly sufficient to protect your assets in a serious lawsuit? The websites often default to the state minimum coverages to show you the most attractive, lowest possible price. But as we discussed earlier, state minimums are dangerously inadequate. A single click to save $20 a month could mean choosing a policy that leaves you financially ruined after a major accident. And the time commitment, it's a mirage. Getting one quote is fast. But to properly shop the market, you need to go to 5, 10, even 15 different websites, meticulously re-entering your name, address, date of birth, VIN number, and driving history over and over and over again. It's exhausting, and most people give up after just 2 or 3 quotes, potentially leaving the best deal on the table simply because they ran out of time or patience. It's like trying to find the cheapest flight by only checking the American and Delta websites, completely ignoring United, JetBlue, Spirit, and Southwest. You're working with incomplete information. This brings us to the third path, the one that the savviest consumers use, and the one that consistently uncovers the best deals that aren't plastered on billboards. This is the path of the independent insurance agent or broker. This is the game changer. An independent agent is the polar opposite of a captive agent. They don't work for one insurance company. They work for you, the client. They are licensed professionals who represent dozens of different insurance carriers, big national brands, smaller regional companies, and specialty insurers you've probably never even heard of. Think of them as a professional shopper for your insurance. Their job is to take your unique situation, your cars, your driving record, your family, your assets, and submit it to their entire network of insurance companies to see who comes back with the best combination of coverage and price. They do all the legwork. You enter your information once with one person, and they come back to you with multiple quotes, laid out and explained in plain English. This is where the real magic happens. Maybe for your profile, a company like Travelers or Safeco has the best rates, but you never would have thought to check them. Maybe a smaller, regional company like Erie Insurance or Auto Owners has an incredible reputation for customer service and a price that blows the big guys out of the water, but they don't spend $1 billion a year on TV ads, so you don't know they exist. The independent agent does. They are your advocate and your advisor. They can look at your situation and say, based on your income and the fact that you own a home, these state minimum liability limits are way too low. We need to increase them to this level to properly protect you. And here's a company that will give you that extra protection for only $6 more a month. That is advice you will never get from a website. That is a level of comparison a captive agent simply cannot provide. And the service doesn't stop after the sale. If you have a claim, you have a personal advocate to help you navigate the process. And best of all, when your policy is up for renewal, if the company raises your rates, your independent agent is already on it. They can proactively reshop your policy with all their other carriers to make sure you're still getting the best deal. You don't have to do a thing. They've turned a time-consuming, frustrating chore into a simple, single conversation. So to recap, the captive agent offers expert service but only for one brand. The direct-to-consumer model offers speed but puts all the risk and work on you. The independent agent, however, combines the best of both worlds. The expert, personalized guidance of a licensed professional with the power of a truly competitive marketplace. It removes the guesswork, it saves you an incredible amount of time, and it leverages competition among dozens of companies to find you a price and a level of coverage that is almost impossible to find on your own. It is, without a doubt, the single most powerful tool an American consumer has for finding affordable, high-quality auto insurance. But finding the right independent agent is key. How do you find one? What questions should you ask to make sure they're really working for you? And what are the red flags to watch out for? That's exactly what we're going to cover next. First, let's talk about where to even start your search. The easiest place is often a simple online search for independent insurance agent near me. But don't just click on the first result. Look for agencies with a professional website and, most importantly, good customer reviews. Google reviews, Yelp, even the Better Business Bureau can give you a glimpse into the experiences of real customers. Did they feel heard? Did the agent save them money? Did they help during a claim? These are the stories you're looking for. Another powerful tool is a network called Trusted Choice. It's a national network of independent agents, and their website has a finder tool that lets you locate affiliated agents in your area. This is a great starting point because these agents are often well-established and have access to a wide range of insurance companies. But honestly, the single best way to find a great agent is through a referral. Ask your friends, family, or coworkers, especially the ones who seem to have their finances in order. Ask your real estate agent or your mortgage lender. These professionals work with insurance agents all the time, and they know who is responsive, knowledgeable, and trustworthy. A personal recommendation from someone you trust is worth its weight in gold. Okay, so now you have a list of 2 or 3 potential agents. What's next? You need to interview them. Yes, I said interview. You are hiring them for a very important job. To protect your assets and save you money. You wouldn't hire someone to work for you without asking a few questions, right? So call them up or schedule a meeting, and come prepared with this list. Question number 1, and it's a big one. How many insurance carriers do you represent? This is the fundamental difference between a captive agent and an independent one. An independent agent should have options. If they say they only work with 2 or 3 companies, they aren't much different from a captive agent. You're looking for an answer like, we work with a dozen, or we have access to over 20 carriers. The more carriers they have, the more doors they can knock on to find you the best combination of price and coverage. Question number 2, a clever follow-up. Which carriers do you write the most business with and why? This is a fantastic question because it cuts through the sales pitch. Their answer will reveal their preferences and potential biases. A great agent will give you an honest answer. They might say, we write a lot with Progressive for new drivers because their rates are very competitive. But for homeowners with a clean record, we often find better value with Travelers or Safeco. They're explaining their strategy. A red flag is an agent who says, oh, we almost always use Company X. Why? Is it because Company X pays them a higher commission? Or is it because it's just easier for them? You want an agent whose loyalty is to you, not to one specific insurance company. Question number 3 is about transparency. How are you compensated? Don't be shy about this. It's not a rude question. A professional will be happy to explain it. Most independent agents are paid a commission by the insurance company, which is a percentage of your premium. This is standard. What you're listening for is openness. If they get cagey or defensive, that's a warning sign. You can even ask, does your commission percentage vary between the different companies you offer? A trustworthy agent will have no problem telling you how their business works. They know their value comes from the service and savings they provide, not from hiding their commission structure. Question number 4 gets to the heart of their process. What is your process for reviewing my current coverage and shopping for new options? You don't want an agent who just plugs your numbers into a machine and spits out the cheapest quote. A great agent will ask you questions. A lot of questions. They'll want to know about your commute, your assets, your family, your future plans. They'll want to see your current policy declarations page to understand what you have now. Their answer should sound something like this. First, I'll review your current policy to identify any potential gaps or areas where you might be overinsured. Then, I'll talk with you to understand your specific needs and budget. After that, I'll get quotes from multiple carriers that are a good fit for your profile, and I'll present you with the top 2 or 3 options side by side, explaining the pros and cons of each. not just the price. That is the answer of a true advisor. And finally, question number 5, my personal favorite. Can you explain liability limits to me like I'm 10 years old? Or uninsured motorist coverage? Or comprehensive versus collision? Pick a topic you're a little fuzzy on. This isn't a test of your knowledge. It's a test of their ability to communicate. The insurance world is filled with jargon and complexity. A great agent is a great teacher. They can break down complicated concepts into simple, understandable terms. If they can't do this, or if they make you feel dumb for asking, they are not the agent for you. Because when you have a claim, you'll be stressed and confused, and you'll need someone who can guide you with clarity and patience. Now, as you're having this conversation, you also need to be watching for the red flags. These are the warning signs that you should hang up the phone and move on to the next name on your list. The first major red flag is the hard sell. If an agent is pressuring you to make a decision right now, run. High-pressure sales tactics have no place in insurance. Phrases like "this rate is only good for today" are almost always a gimmick. A good agent wants you to be comfortable and confident in your decision. They'll give you time to review the quotes and ask follow-up questions. The second red flag is a sole focus on price. It sounds counterintuitive, right? We're trying to find affordable insurance. But an agent whose only selling point is, "I can get you the cheapest rate," is doing you a massive disservice. Price is only one part of the equation. A policy that costs $20 less a month is worthless if it has a massive coverage gap that could cost you tens of thousands of dollars after an accident. A good agent talks about value, which is the intersection of the right coverage and a competitive price. They will point out where you can safely lower coverage to save money, but they will also strongly advise against cutting corners on critical protections, like liability. The third red flag is poor communication. Did it take them 3 days to return your initial call? Are their emails full of typos and unclear language? This is a preview of the service you'll receive when you're actually a client. Imagine trying to get a hold of them after a car accident. You want an agent who is responsive, professional, and clear in their communications from the very first interaction. And the final red flag is an agent who can't or won't answer the questions we just went over. If they're evasive about the number of carriers they use, if they can't explain their own compensation, or if they dismiss your questions about coverage, they are not the partner you need. They're not an advisor, they're just a salesperson. So what does a great agent look like? They're the opposite of all these red flags. They are a patient educator. They present you with multiple options and clearly explain the differences. They are transparent. They are responsive. They don't just sell you a policy, they build a relationship. A great independent agent will proactively reach out to you before your renewal each year to reshop your policy, to make sure you're still getting the best deal, and to see if your needs have changed. Did you get a new car? Did your teenage son start driving? They stay on top of it for you. This is the real power of using a top-tier independent agent. You're not just getting access to more companies, you're getting a personal insurance advisor. You're getting a human being who you can call directly when something goes wrong. You're not navigating a faceless 1-800 number and a phone tree from hell. You're calling someone who knows your name, knows your policies, and whose job it is to advocate on your behalf. That peace of mind is often worth more than any small difference in premium. Finding this person takes a little bit of upfront work, making a few calls, asking a few questions, but the long-term payoff is enormous, both in potential savings and in the security of knowing you are properly protected. But let's say you've done all this and you've found a great policy, either through an agent or on your own. Your work isn't over. The insurance landscape is always changing, and your life is always changing. The price you get today is not the price you'll have forever. So how do you make sure you keep a low rate year after year? It requires a strategy. The strategy is simple, but it requires discipline. You need to treat your auto insurance like any other major financial product in your life. Your mortgage, your retirement account, your investments. You wouldn't just set those and forget them for a decade, would you? You'd review them. You'd check their performance. You'd make sure they're still working for you. Your insurance is no different. The core of the strategy is this. You must reshop your auto insurance at least once a year. Mark it on your calendar. Set a digital reminder. Do whatever it takes to make it an annual financial ritual. Think of it as your annual insurance checkup. This isn't about being disloyal. It's about being smart. The insurance market is a living, breathing thing. Rates for the exact same driver at the exact same company can fluctuate wildly from one year to the next based on their internal data, their losses in a particular state, or their strategy for attracting new customers. The company that gave you the best rate last year might be one of the most expensive for you this year, through no fault of your own. And then there's the most counterintuitive secret in the entire industry, something companies don't exactly advertise. It's called the loyalty penalty. You'd think that staying with a company for 5, 10, or 15 years would earn you the best possible rates. They value your business, right? Well, not always. Many insurers have complex algorithms that have found that longtime customers are less likely to leave. They're comfortable. They don't want the hassle of shopping around. And because you're a captive audience, your rates can slowly, almost imperceptibly, creep up year after year. A few percent here, a few dollars there. After 5 years, you could be paying hundreds more than a brand new customer with the exact same driving record. They lure in new people with aggressive, low teaser rates, and subsidize those discounts with the gradual increases on their loyal long-term clients. By not shopping, you are potentially paying a penalty for your loyalty. The only way to fight this is to prove their algorithm wrong. You have to be willing to walk. So your annual checkup is non-negotiable. But there are other specific life events that should trigger an immediate insurance shopping spree, because they can fundamentally change how companies see you. First, moving. If you move to a new zip code, even one just a few miles away, you need to shop. Rates are calculated down to a hyperlocal level. Moving from a dense urban area to a quiet suburb can slash your premium. But the reverse is also true. Don't just assume your current company will automatically give you the best new rate for your new address. Second, a change in your marital status. Getting married almost always results in a significant discount. Insurers' data shows that married people tend to be more responsible drivers and file fewer claims. It's a huge pricing factor. The moment you tie the knot, get new quotes. Third, buying a new car. This one seems obvious, but people often make a critical mistake. They buy the car first, then call their existing insurer to add it to their policy. Don't do this. Before you even sign the papers for that new vehicle, you should be getting quotes from multiple companies for that specific car. One company might have great rates for your old Honda Civic, but terrible rates for a new Ford F-150. The best insurer for one car is not always the best for another. Fourth, a major life event falls off your record. Did you have an at-fault accident 3 or 5 years ago? Most states and companies only look back a certain number of years. The month that accident officially ages off your record is like a financial holiday. Your risk profile just dramatically improved. It's the perfect time to see how much that's worth on the open market. Fifth, a significant change in your driving habits. The world has changed. Millions of people now work from home or have hybrid schedules. If you've gone from a 50-mile round-trip commute to a 5-mile commute, or no commute at all, you need to tell your insurer and you need to get new quotes. Annual mileage is a huge rating factor. You are no longer the same risk you were, and you shouldn't pay as if you are. And finally, a big improvement in your credit score. As we discussed, in most states, your credit-based insurance score is a massive factor. If you've spent the last year paying down debt, clearing up accounts, and your score has jumped 50 or 100 points, you are a whole new customer in the eyes of an insurer. Your improved financial responsibility suggests you're a lower risk on the road, and you deserve a lower rate. So, when one of these events happens or during your annual checkup, what do? You simply run the play we've spent this whole series learning. You go back to the online comparison tools. You call an independent agent. You get 3 to 5 fresh quotes. It's not starting from scratch. You already know your coverage needs. You already have your documents ready. This time it'll take you 30 minutes, not 3 hours. But here's the pro-level move. Once you have a better quote in hand, your first call shouldn't be to the new company to sign up. It should be to your current company's customer service or retention department. You call them and you say very politely, "Hello, my policy is up for renewal and I've been shopping around. I've been a customer for X years and I'd really like to stay with you, but I have a quote from another company for the same coverage that's $200 cheaper. Is there anything you can do to match that or come close to it?" You've now changed the entire dynamic. You're no longer a passive customer accepting a renewal price. You are an informed consumer with a powerful bargaining chip. A competitor's offer. Sometimes they'll say no. But you would be absolutely shocked at how often a customer service agent can suddenly find new discounts you weren't getting. They might rerun your rating, apply a special retention discount, or adjust your profile. They want to keep your business. It's cheaper for them to give you a discount than to spend hundreds on marketing to acquire a new customer. Giving them a chance to keep you is the easiest possible way to win. If they can match the price, you save money without any of the hassle of switching. If they can't, you thank them for their time, and you switch with confidence knowing you did your due diligence. This is the cycle. This is the system. It's a continuous loop of living your life, monitoring for trigger events, and running a quick, efficient checkup once a year to ensure you are never, ever overpaying. We've covered a massive amount of ground together. We started by demystifying the jargon, breaking down what liability, collision, and comprehensive coverage actually mean, so you could build a policy that protects you without padding an agent's commission. We pulled back the curtain on the secret rating factors, your credit score, your zip code, your job, so you could understand how you're being judged and what you can control. We created a battle plan for getting quotes, leveraging the speed of online tools and the expertise of independent agents to make the market compete for your business. We walked through every discount available, from bundling policies to installing a telematics device, ensuring no dollar was left on the table. And now you have the long-term strategy to keep that low rate, not just for this year but for every year to come. The journey to finding affordable auto insurance can feel confusing and frustrating. It's designed to be that way. The complexity benefits the industry, not you. But now you have the map. You have the knowledge to turn a frustrating chore into an empowering financial decision. You have the power to save hundreds, maybe even thousands of dollars a year. Money that you can use to pay down debt, invest for the future, or just enjoy your life. This is more than just a guide to car insurance. It's a lesson in taking control of your financial life. It's about refusing to accept the default option, and instead, making proactive choices that put your money back in your pocket. You've done the hard work by making it to the end of this. Now the final step is to take action. Use this guide. Run the plays. Get the quotes. Secure your rate. And when you do, I want you to come back to this video and leave a comment telling me how much you saved. Your success story will inspire someone else to take control too. Thank you for your time and your trust. Drive safe and save money.